You're listening to the Annuity Agents Podcast with Anthony Owen. Anthony is the co-founder of a $20 million per year annuity agency, president of Annuity Agents Alliance and Annuity Innovation Systems, co-founder of Safe Money Radio Marketing, and monthly contributor to Think Advisor. Each week, Anthony and his partners at Annuity Agents Alliance update you on the annuity business with marketing, sales tools, sales process, and case design strategies. Before we get started, hit that like button and subscribe so you don't miss information that will help you build your annuity business.
Hello, everyone. This is Anthony Owen. Welcome to the podcast. I'm president of Annuity Agents Alliance, and today I have with us Scott Soares. Scott Soares is our life insurance and long-term care expert. And we have a lot of great divisional labor here at Annuity Agents Alliance, including all the people that help us process policies. And one of the things that we want to make sure we have a specialist on is life insurance and LTC, because if you're not in that game every single day of the year, it can be a little overwhelming. So, Scott, welcome to the podcast.
Morning. How are you doing today?
Fantastic. So what we're going to be doing today is we're going to be going over a couple things on how you can bring LTC into your business the simplest and most productive way. We're going to talk a little bit about why we're not using traditional LTC that much these days, kind of the living benefits and riders and what's available, and then also go into some sales tips. How can you actually apply this in your business? If you're like most of the partners I work with, this is one of the most underutilized product in the market, yet one of the most lucrative and one of the most needed by your clients. So pay attention to this. Call us if you do not have this in your business or you want help with it, because Scott can definitely help you out. So Scott, why don't we get started? Why are we not using traditional LTC these days, and what are our alternatives?
Yeah, well, if you've ever sold one of these policies, traditional long-term care, we know that it's not guaranteed. So your premiums are either going up or your benefits are going down, and it's use it or lose it most of the time. So the low interest rate environment basically killed off all of those policies. We had 100 of them to sell, 10 years ago. And I think I know of two now, and Mutual of Omaha is the one that I'm using these days. It's good to get something. It is the cheapest, obviously, but your premiums are going to go up each and every year. So, or not every year, I'm sorry, every couple years, more than likely. So non-guaranteed. We got smart. We started using life insurance and advancing the death benefit. So it's checking a lot of boxes. It's not use it or lose it. You're either going to have a death benefit paid out. You're going to have some cash values that in most cases to use. So like a walkaway value. And then, if you trigger the benefits, which is why you're using or why you're buying this, it's a better way of doing things. And I'm glad we figured out a good problem.
Yeah, absolutely. And we do have some partners that are utilizing this massively. One of them is the top selling agent for One America in Texas. And, if you want to, increase your revenue by like 20 or 30% and also decrease your liability, because if you're not offering long-term care, if you're going out and meeting with people and doing comprehensive designs and you're not offering long-term care, you're actually opening yourself up to some liability. You don't have to be a fiduciary to create liability. If you're licensed to sell these products and it's not part of your discussion, then you could be doing a legal disservice to your clients. Let's talk a little bit. Yeah, go ahead.
I was going to say, it should be part of every financial plan, right? I mean, if you're helping these people, you're trying to avoid their spend down in their time of need. So if I've ever talked to you before, you've heard me say this before, wealthy people know how to leverage their money. And do you think the Warren Buffetts and the Elon Musks don't leverage their money. Why spend a dollar for a dollar of long-term care when we can show our clients spend 65 cents on the dollar if you just plan it correctly and you use it the right way. So
yeah, and like you said, if you don't use it, you don't lose it. So let me go ahead and share this little cheat sheet that you made, which is, by the way, just amazing. I mean, it's such a good tool, and all of our partners have access to this tool. So
please
pull
reach
this up,
out.
and we have this in a nice little PDF for you guys, but I'm just going to show it here in Excel. Can you see that, Scott?
Yeah.
Okay, great.
I think can you blow it up a little bit, or?
Yeah, let me see if we can make it a little larger. Oh, maybe a little too big, huh? Let's do 150% there. Okay.
There you go.
How about that? Okay, great. So what do we need to be looking on that? Let's go ahead and kind of use this cheat sheet and then go through some of your sales ideas.
Sure. Before we do that, let me go over something that I get asked every day on is I know a lot of people are talking about living benefits and how those work versus a true long-term care rider, where you need to have the CE credits tagged on your license. There's a difference there. Living benefits, you don't need the long-term care designation. Long-term care riders, you do. And some of these hybrid products, you also need the designation on your license. So California requires 8 hours every 2 years. Really simple to do. I suggest you do that with the ethics and the annuity CE credits you always do. You might as well throw it on there so you've got access to it. Living benefits. I call that, it's essentially a discount on the advance of the death benefit. So easiest way to explain it is you've got two 75-year-olds who trigger benefits on the same day. One of them has a life expectancy of, let's say, 18 months. And the company says, well, that's a pretty long time, so we're only going to give you 60% of the benefits. Whereas a 75-year-old triggers on the same day, his life expectancy might only be 13 months, so they're going to give him 90% of the benefits. So when you sell these to your clients or you explain the benefits, it's not a dollar value you can give them. It's arbitrary. And it's at the time they trigger the benefits is when you figure out how much you're going to get, right? And a lot of these policies might be 24 or 25% a year, but then they put that discount in there. So you might only be getting 12.5% or something, half of what you were thinking you were going to get. So just be careful when you're explaining those riders. They are free and they're a nice benefit to talk about. Same goes, for the critical illness. So that's chronic and critical illness that gets tagged as living benefits. But just be aware of that versus a true long-term care rider where it's an acceleration percentage. Most of the time I'm designing it with a 2% of the face amount, meaning you got a $250,000 policy, let's say Hancock or Prudential or somebody like that. And we put a 2% rider on there. That's kicking out a 5% a month, or I'm sorry, $5,000 a month benefit for 50 months, right? 2% times 50 times is 100%. So we can advance it 1%, 2%, or 4%, depending on how long you want that benefit to last. Does that make sense?
Yeah, absolutely.
So I just want to be clear on those. Those are the differences between those riders for, we can put those on Universal Life. We can put those on IULs now. Pretty handy to do. As far as it's just another version of coverage. So different than these single premium hybrid products, which we'll go over right now.
Got it. And then you had a sales idea with National Western's lifetime returns. Let's go over that.
Yes. I call it left pocket, right pocket, right? You're going, this is money that is on the sidelines. It is, when you ask them, what's this $100,000 sitting in the bank account, what's the number one response? It's always for emergencies, right? Or I want to leave it to my kids or my grandkids. Okay, well, Mr. Client, let's, what if we move the money from your left pocket to your right pocket, from a bank to an insurance company? And for that, I'm going to give you a menu of benefits. For that $100,000, let's say you're a roughly 70-year-old, you're going to get maybe $170,000 of death benefit. You're going to get $170,000 of long-term care, because that's what we're going to advance. The neat thing on that product is it's return of premium. You can always get your $100,000 back, no questions asked. It's an index universal life, so there's some growth potential, and the best part is it's got a great commission. It's 11%.
Yeah,
almost double than an annuity pays you. Right?
Yeah, absolutely. And a lot of this is just asking questions. I mean, that's the big problem I see is we go through the annuity sale, and then clients aren't asking these questions because they've pretty much given up on long-term care. Like, they think it's not even an option, right?
Right. They either can't get it or it's too expensive, right?
Right. So ask the questions, set the stage, do the analogy, right pocket, left pocket, do the what ifs, so what if you could get long-term care without any premiums? All you have to do is use the money that you already have. And what if it was simplified underwriting? Yeah. What if you just had to answer some questions and not go through full medical underwriting? So you just ask a bunch of what ifs and do analogies, get them open to the question. This could be done on policy delivery if you're selling annuities. Or it could be done during the fact finding, preferably during the fact finding process. You're setting the stage for what you end up eventually doing, right? So you're doing the fact finder, you're looking at the resources that the client has, you have an approximation of how much of those resources that you're going to need to do for some income design or growth and spend down design. And then that there's going to be additional premium available for long-term care. And the great thing about this, Scott, correct me if I'm wrong, this doesn't really fall into a suitability because of the return of premium thing, right? If you write this after the annuity is written, there's not a suitability review in the same context as So
it's not in the calculation. The neat thing about this too, as you mentioned real fast, is it's an instant decision product. Hey, Mr. Client, does this interest you? Do you want this menu of benefits? Do you want instant access or all your money back anytime you want? Great. Let's see if you qualify. It's a 15-minute interview. And at the end of that interview, we know whether he or she qualifies. So
don't go straight into the product. Set the stage when you're pique the client's interest. Let them, give them some hope. Know that these products are available in concept through concept conversations, and then you'll get the client interested. And then this is all done with lazy money. It's money that you weren't going to, unless you're doing AUM, this isn't money you were going to be able to touch anyway in most cases.
Right.
What if someone has qualified money? What do we do there?
Good question. We do have products for that. There's a few of them out there, and I'll go over one of them that I like, which is One America. Essentially, what we're doing is it's a third spoke of the wheel. So we take qualified money, we roll it, and it's all a packaged product, by the way. We roll it into it's an internal SPIA, qualified SPIA, that pays into a whole life policy over 10 years. You get a bonus of 10% on top of it. And then it will advance, like I said, let's call it 2% of that face amount, which will kick out a long-term care benefit. So let me back up for a second. I know that's a lot. So let's just do an example. 100,000 qualified money goes in. You'll get a 10% bonus. So the internal annuity the internal SPIA that pays out over 10 years is at 110,000. So 11,000 a year will get fed into the whole life policy, which then at the end of 10 years, obviously it's all paid up. And now you've got a guaranteed policy for life on whatever benefit that kicks out. The neat thing with the product, though, is we can build in inflation riders. So we can really mimic a traditional long-term care policy with this. If for some reason you triggered benefits halfway through those 10 years, let's say in the 5th year, you triggered the benefit. Well, the policy is a paid-up policy already, so you'd have another 5 years of $11,000 being paid to you on the side. That would be taxable, by the way.
Right.
And then your benefits, which are always tax-free with long-term care, would still pay out. So kind of a neat little thing there. That's a waiver is what that is, right? But yeah, we can use qualified money lots of different ways. That's just a great way to, if they don't have any non-qualified money to use, we've got products.
Yeah. And, we won't go into details on this, but if you guys are listening to this and you're like, geez, I'm not really familiar with this situation, you really do need to call us and let us help you. We have some strategies where we use indexed annuities with 10% penalty-free withdrawals to fund some of these things. Some no-fee indexed annuities that enhance death benefit. So you get a massive increase in your death benefit while you're using the penalty-free withdrawals to fund some of these concepts. And then you can get your annuity sale and the LTC sale all combined. And the products that we're using on the index side had LTC benefits of their own as well, potentially too. So it's a total double up on everything while avoiding all the fees. So, and then,
yeah, I'm sorry,
go ahead. No, go ahead.
I was going to say, I'll mention to this because obviously you guys sell a lot of annuities. Those doublers, be careful explaining those now.
Right.
What that is, right, is it doubles the payout until the money's gone. So they're getting their own money back quicker. It's a liquidity rider, right, is what it is.
Right.
I know it's sold. Some guys call it long-term care. It's not. It's triggered the same way, but it's really a liquidity rider, right, that is giving the clients back their money quicker. And then hopefully you get into the grading.
If you're turning on income at like age 65 or something like that, the chances of that account value being greater than zero when a client is 80 is highly unlikely. And even if it is, the LTC benefit's going to cut off as soon as that account value hits zero. And when you take that double income, it's going to hit zero really fast. So, those LTC doublers are better for like long periods of deferral before income rider activation. Hey, what about the 4Care? That's a popular one with Global Atlantic.
Definitely. So we can use annuities too, by the way, and not to get all nerdy on you, but we use the Pension Protection Act. It's actually part of the HIPAA laws to get, they're filed specifically, the products are filed specifically with the states that when you actually can pull money out of a non-qualified annuity tax-free. A lot of people don't know this. So let's take an example. You've got, you come across a client with multiple annuities. Now this is money obviously they don't need for income. This is, maybe they've got multiple annuities and you're using 2 or 3 of them for the income, and you've got an extra one over here. Or they've got a pension or something, right, taking care of their income. So this is, you don't want to dip into that obviously if they need it, and that's a very hard sale if you did. But this is money they don't need for income. So just keep that in mind. If you come across a non-qualified annuity that has large gains, you're probably going to want to pick one that has the gains in it, because when triggered for long-term care, same way, 2 of the 6 ADLs, right? It will get paid out tax-free.
We're doing a 1035 to this product, and then any of the gains that came from the previous annuity, plus any gains that come from the 4Care, which aren't going to be significant because that's not what this product is designed for. But any gains from the prior annuity and the current annuity the 4Care product are all tax-free for the purpose of LTC.
Exactly. And here's how it's sold. It's very easy to explain to a client in a minute. If you get through the first 5 questions, I'm going to double your money. So that 100 turns into 200,000 of long-term care dollars to use. And if you can get through the next 5 questions, I'm going to triple your money. Would this interest you? It's very simple to explain. If you're over 70, there is an interview. But if you're not, no interview taken. Obviously, it's an annuity, so there's no death benefit. If you died, you're getting the accumulation value. If you don't trigger benefits, it's just another annuity, right? But
there's a death benefit. It's just the account value.
Yeah, exactly. So it's just like a regular annuity, right, at that point. But if you trigger the benefits, you get this multiplier. It's leveraging built into these products. So,
and I think a lot of, I have partners that write $1 million, $2 million policies, and so they a lot of times they ignore this because they think, well, I'm not going to be able to get someone to use $500,000 of lazy money for this. These policies don't have to be big, right? I mean,
right.
Could just 100,000 could turn into 300,000. It's something. Right. It would cover at least 2 years of very nice benefits. LTC benefits, maybe 3 years of something that's a lower cost. So it's something, right? You're doing something. The average stay in long-term care is what, 3 years?
2.5.
2.5. So, I mean, if you can get someone to put 50 or 100 or 150,000 into one of these, then you're at least covering the base, right? You're at least, you're given something for that LTC coverage to not eat into the estate. So it doesn't have to be big sales, and they're so simple. It's knockout questions, interviews, and then funding. I mean, once you've done the knockout questions and the interview, the policy is going to get issued. So you don't have to, anything other than that. So it's just a matter of funding after that.
That's a good point. I'll mention real fast, field underwriting on these things. Obviously we're talking sometimes older clients on this stuff. If it's a question, One America's got a great pre-qualification sheet. You fill it out, as much detail as possible, get it back to me. It comes back in 24 hours with, it's an informal, we think we can cover you, or even pivot to one of these annuity products, right? That gives me a good idea of what direction to point you in to get some coverage. And then, like you mentioned, there are knockout questions for, let's say, that National Western product. Going in whether they're going to get approved or not in that 15 minutes. It's just a great way they built these things.
Yeah, and this is why it's so important to work with someone like Scott too, because for example, on the 4Care, if you didn't know it, 4Care is an automatic reject if they've been rejected by other long-term care. So
for a year,
for a year. So what we do is we have your client apply for 4Care first, see if they get approved, and then if they don't, then we move on to the other products. So there's little strategies like that. There's cheat sheets. There's field underwriting guides. All these things that Scott will help you with. When it comes to life insurance, we have a generic Part B of an application you can complete so that you kind of know. Scott can choose products that they're more likely to get approved with. That's one of the big things about life insurance is, a lot of guys don't do it because they don't like the client's chance of getting rejection. Well, have Scott pre-screen your case for you with a generic Part B in a HIPAA form. And then we can make sure we're putting that client with products where they're more likely to get accepted and reduce the potential loss of time and resources and client rejection that you might experience. So
if you've got a question, and we're talking life insurance right now, or even the long-term care stuff, send me an email with very specific, get as specific as you can, and I can get a risk assessment done within a day or so. if you're worried about that stuff, submitting an app and going through underwriting for a month and a half, give me 24 hours, 48 hours, and we'll have a direction for you.
Yeah, absolutely. So if you're working with us, you know who Scott is. If you don't, talk to your marketer and we'll be glad to help you with that. And if you're not working with us, reach out to us at annuityagentalliance.com or 888-742-4368 extension 100. And we'll be glad to get you set up for this and get you help. Well, Scott, thank you so much for your time today. It's always been a pleasure. You're a wealth of knowledge when it comes to this stuff. And we're so thankful that we have you around to help us with this brain trust of long-term care and life insurance and all the things related to it.
Appreciate it. Yeah, call me anytime.
Okay, guys, thanks again. And join us next time for the Annuity Agents Alliance podcast. Thanks for
Thanks for listening to the Annuity Agents Podcast with Anthony Owen. For more information on how Annuity Agents Alliance will help you build your annuity business, go to annuityagentalliance.com. If you're watching on YouTube, please do us a favor and don't forget to hit that like button. Also, don't forget to subscribe and ring that bell to be notified of future podcasts. If listening on a podcast channel, please leave your rating and review if you like the show. The information and opinions expressed here by third parties or guests are believed to be reliable, but the information cannot be verified or guaranteed by Annuity Agents Alliance. The opinions of guests do not necessarily represent those of Annuity Agents Alliance or its partners. The prior information does not represent tax, legal, or investment advice, and is for licensed financial professional use only.